Next up, let's talk about trading setups and support and resistance. So the highest probability SR level trade or trade based on support and resistance levels is the first test of a broken level from the other side. What does that mean? Well, let's say, for instance, price breaks past resistance. Okay, so there's this level of resistance, price over is below it. It breaks past it, and if it comes back down, this is an instance where price will be testing that previous resistance level, which will now act as support. This first test of a broken level has a high probability of holding, meaning that this, in theory, the price should, if price breaks past that level and comes back down, the price should hold and return to the upside. And we also see the same in reverse, where if price breaks past support, let's say our support level, and then if price breaks down, then tests that previous support level, it comes back up and it tests that support level, that previous support level will now act as resistance and has a high probability of holding and acting as a significant level of resistance and should reject price, where it will then continue downward. Since the chance of a support and resistance level holding decreases with each test, when a SR flip does occur, when that support and resistance flip does occur and is tested for the first time, it has a high probability of actually holding and successfully rejecting price. And there's some things we want to think about. Are there any broken support levels above the current price? That's when you want to look to short, right? Because if we broke past support and we come back up, most likely that broken support is now going to act as resistance, and it's most likely going to reject. Price is going to be rejected from there. That's when we want to look to short. Same thing with the broken resistance level. If there's a broken resistance level below current price, if price comes back down to it, that's when we want to look to long. Basically, buy broken resistance when price returns to it, sell broken support when price returns to it. Now, trades taken off of later tests may have a lower probability of holding compared to the first test, but they still can be taken and they still can be successful holdings of support and resistance, of new levels of support and resistance as retests. And it's advised to still take them if you find other TA, technical analysis methods, support that theory, right? If you have the idea that price is going to reject from that level or retrace from that level, that's when it's advised to still take them. And these other things these other indications could be based off of indicators, technical indicators, RSIs, Bollinger Bands, moving average crossovers, etc. Fibonacci retracements can also be useful as well, and any other indicators or technical methods, analysis methods that you may employ. So turning here is Ethereum to the US dollar on the daily chart. What we're looking at here are specific instances of SR flips and potential trade entries. So we'll start from the right and work our way to the left. Here particularly, so this $2,650 level for Ethereum has proven to be a significant level of support and resistance throughout 2021 and into 2022 as well. So take a look here, this particular shape. So starting from here, from November, we see Ethereum has been in a downtrend. Overall, lower highs, lower lows, prices are coming down, right? We do reach this particular level, and we see a significant breach on this candle. This is a rather large candle in late January that really helped cement and push Ethereum below and into this range. We see as it's broken, this level is now acting as resistance, right? So the first test we observe on this particular candle. And what's interesting here is that we see it has a rather small body. Really, price action for 2 days in a row. Really tight range in terms of open and closes. We do see the candle wick breaking past the resistance level, but once again, we don't want to consider a wick for a level break, because we see that just as it came up, it quickly came down, and really it closed just maybe a hair higher than what it actually opened. I'll move the mouse cursor so you can actually see that, but that's a really long wick, indicating that that's not a confident move from the market. Now, that was our first test, right? The first test rejected. The second test, possibly, we do see a bit of a breakdown. We see the second test that was rejected on the next day, right? And then the third time, we could say on this third candle where price was attempting to breach past, it actually held through. Now, once we actually come above, now this level acts as support, right? And this is our first retest. We see another flip. Yeah, we saw a flip from support to resistance on the way down, and we see a flip from resistance to support on the way up. Particularly, we see on this candle, price comes up, it comes back down. We see a small wick underneath the support level of 2650, but ultimately the candle closes above, but still very close to the line. The next candle, very small body, we do see another wick below, and a small wick on top, but rather low candle body once again, rather small candle body, I should say. And this is another indication that the market, that the price action did not significantly fall below this level, right? The level really held, even though the wick came below. And keep in mind, we're taking a look at the daily candle. So that means there's 24 hours of price data, constant price data in each one of these candles. It's not just 8 hours of trading time like the New York Stock Exchange or other traditional financial sectors or markets. This is something that is a global market. There's 24 hours of trading time, 7 days a week. So it can be a lot of volatility and price action for one specific daily candle, but that's because it is 24 hours and it's a global market. We see other indications as well, but the main idea is that as price does break past the first instance of it returning to that price level, we do see successfully that those price levels hold. We see it here. We see it also, let's see here. Here's another instance. So price comes up to here, is rejected. It finally breaks past. We do see over here, this wick comes back down to the line, but ultimately price continues upward. So some considerations for strong support and resistance levels. We want to look for a high number of touches once the level has been broken. More touches from the same direction is equal to the level weakening as buyers or sellers are absorbed. Once the level is broken, we see that price moves to the other side, and then that we can consider a fresh start, because now it's a reset on the number of touches from that new direction, right? If price is moving upwards and hitting resistance, it breaks past, and now it's hitting that same level, but now it acts as support. That's a new direction, so we would consider that a reset, so to speak, in the number of touches from that direction, at least for that particular instance, right? So if price is underneath and hitting that line, it's coming from underneath, it breaks past, and now it's above. Now it's a bit of a reset, it's a fresh start, so to speak. We also want to consider volatile touches once the level is broken. So how strongly did price react upon testing the level? Was it immediately knocked down? Did it hover or stay at the level before gradually falling? You know, there's differences. We also want to look at towards volume as well, volume figures. In regards to the size of candles, a bigger swing away or a bigger rejection indicates that the level was more significant or a stronger level. It's a much more impactful level. We also want to consider recent price action. Don't use price levels or that were good in the past but are now insignificant. We want to keep in mind what's going on right now, what's relative to price action now. Where was price? Where is price? Where could price go? That's what we want to consider. And we also want to read the chart from right to left. Sometimes it's more important to take in consideration more recent data over historical data, right? The more recent data shows an updated version or updated reading on market sentiment and overall how the market is shaping up. Sometimes we're so used to reading things from left to right like a book that we always look towards the left of the chart. And sometimes that's not always the best idea, because the more recent stuff that's more relevant to what we're doing right now will always be on the right when it comes to trading charts. Consider duration. So levels that were respected as support and resistance for longer periods of time tend to be stronger or more significant levels. For example, a resistance level holding for several weeks will turn into stronger support compared to a level that was resistance for only a few hours, right? We want to consider how long or for how many touches, how long was that level? Was this level held for weeks or months, or was it held for days or maybe just hours? And here's a tip for drawing. Look towards most recent lows before the break downwards, or the most recent highs before the break upwards. This is where we can start to see, all right, how is the market shaping? The more recent lows, are they ascending or are they descending? If we're breaking downwards and the more recent lows are in this descending fashion, that's showing that the price floor is falling up until the point where it reaches that support level, and if that trend does continue, that support level will fall. And the same thing in reverse for highs and breaks to the upside. Next up, we'll talk about retests and retracements. So basically, there are two types of retests or retracements, or two main types. Basically, when price comes up to a level and either retest it again, here's a test, here's another test, or price breaks past it and comes back down, that's another retest. There's two main types. There's the micro retest, which is typically seen or traded on the lower time frames. This we can consider the 5-minute, the 15-minute, the 1 hour. And this typically occurs right after a level is broken. It's considered a lower or low probability rate compared to the other main type of retest that we'll talk about. Because it's based on the lower time frames, we haven't seen higher time frame proof that the level has been broken yet, right? So if you're trading off the 30-minute, you're trading off the hour, you might see a candle close over above a significant level, a significant price level. We have evidence that the level was broken based on the lower time frames, but we don't have that daily or that weekly candle close to give us more concrete proof that the level is broken and more confidence in that move, at least for now. It's also important to consider sometimes price does not come back all the way to the level itself. Sometimes price doesn't come back at all. So, there's some, we want to see greater concrete, greater confident proof, or have confidence in the proof for certain levels being broken as analysts, but the reality is the market doesn't always play by the books, right? It doesn't always play by the rules. So, we think of, hey, here's a level, price is breaking past it. We want to wait for that retest, right? Or the retracement. We want to see price retrace to that broken resistance level. Now it's acting in support. We want to see it come down to there and bounce up. Well, what's to say price only comes halfway and then keeps going? Or price just doesn't retrace at all. Price just keeps going up, and that does happen sometimes. So, it really depends on a number of factors. I would say it's situational, but generally we want to wait for higher time frame proof. Generally we want to wait for those retracements, to wait for price to come back to those levels to give further confidence that price has actually broken past that level or that range and is in a new range, so to speak. but it can be situational and doesn't always happen the way we want it to, or the way it should happen, like it says in the books. Now, the other retest we'll talk about is a rounded retest, or a longer retest. This is seen on both lower time frames and higher time frames. Here we see a larger amount of time and space between the level break and the retest. This means that, so let's say here is our level, price is coming up, and we break past. Now, the difference between here is that the micro retest is occurring right after the level is broken. So 1, 2, 3, and then we come up, and then we retest immediately in the micro. On a rounded retest, there's much more time and space between the break and then the retest. So maybe it's much more rounded. That's where we get the rounded phrase from, because there's more candles in between the actual level break and then the retest, compared to the micro, which is pretty much immediate, the candle right after. And we consider these rounded retests, these more drawn out retests, to have higher probability of actually holding. Both the lower time frame and higher time frame evidence that the level has been broken, we can consider to have higher probability. Once again, those more volatile moves, those more dramatic moves to the upside or the downside, typically are signs of volatility or instability. Whereas with the rounded retest, where price has more time to break above the level and then sort of settle and consolidate a bit before retracing and retesting that level, that gives a bit more credence and a bit more weight to the idea that the price is actually going to hold at that level. And this coincides with the higher time frames, the general amount of space, and just overall higher probability of the level actually holding. Now, both are considered valid approaches. I would say it is based on preference and your trading style, lower time frame versus higher time frame, your risk and how much you want to take on, and your experience. I find that both are valid, and it really is situational and subjective. For me, I don't want to enter a trade just on a retest. I personally like to see other indications from a variety of factors, whether that's volume, other indicators, RSIs, and so on, to see, hey, if the market's going to turn around. Like, I'll use these tools as a means to have an understanding of what could happen and what to look out for and when to look out for it, and then use other tools in my arsenal to help build that argument. Like, all right, well, price is coming down. It looks like maybe certain indicators are pointing that there might be a reversal soon, or maybe there's some sort of divergence coming up. I'm going to place along somewhere above that support level. That way, when price comes down and retests it, I'm ensuring that my order is filled, and I can have a stop loss right below the support level. That way, in case I am wrong and price does fall, I am wrong small, so to speak, right? I only risk a small amount of my capital. Once again, here's just this idea of this is Ethereum to US dollar. There's several retracements. So here, this is a great example of a micro retracement, right? We see this test, a break, another test again. We could say that this right here was a level of support and resistance right here, the significant level, maybe about 2,400. So let's say ETH broke past here, shot up to this resistance level, and on the next candle came back down and then came back up, right? We could also say here, I'm just looking for examples. Here's an example, actually. Yeah, so price came down here, broke past this level of support, and it confidently closed below it, right? It actually went down a little bit more, retraced back up, closed. It looks like towards the beginning, it retraced back up to this level of 2650, but ultimately held and was rejected to produce an even lower low. So this is a great example of a micro retest. This could be seen as a rounded retest. So price breaks up. We do see a retest to this level of about 20, 26, 27, and then it seems like the wick came up. So if you did buy right here at some point and you sold during this wick, that was a profitable trade. It would have been riskier, but if we're just looking for rounded retests and micro retests, that was a valid trade. So let's talk about time frames a little bit. Once again, I encourage you to please check out the time frames video, because it really goes into much more depth on time frames in regards to many facets of trading. So higher time frames are considered more reliable versus lower time frames in regards to support and resistance. Generally, higher time frame SR breaks and setups are less frequent. They do not form as often due to the nature of larger time frames taking more time to play out. It's just the inherent trait, right? Each one of those candles takes a day or takes days or weeks to form and to close. So we're not going to see as many setups on the daily chart compared to maybe say the hourly or maybe the 30-minute. Overall, it's best to find a time frame that works for you and you're comfortable trading. You want to find a good balance between setup frequency and quality and reliability. An example of this could be trading off the daily level breaks and retests, and maybe, or just trading off of 4-hour level breaks and retests. So there's a lot of different ways you can approach this and incorporate these methods or these ideologies in your trading and have it add to your trading and supplement it rather than take away. Some final notes on support and resistance. So these lines are not set in stone rules that are 100% accurate all the time. And once again, they shouldn't be relied on solely on their own. Support and resistance can be highly subjective. Different traders may see differing levels of importance, and it really depends on your trading style and what you see and what you're looking for and your experience as well. It can also be thought of more as an art than a science. That I think is subjective, because a bit more of science is a bit more a practicality and the actual data itself, whereas with art, we could see it's a bit more subjective. So I think it can have elements of both. The main thing to do is to find what works for you, using these concepts and to build your own system and not just blindly follow anyone else's support and resistance lines, because quite frankly, you don't know if they know what they're talking about or not. You also don't want to force levels when they aren't clear. The best trades come from clear setups, indications, and are worth the wait. Don't try to rush or front run any support and resistance flips or any retests, especially on higher time frames, because they take longer to play out. Wait for those candle closes. I promise you there will be so many more trades out there that you can take. There's no need to always be in a trade. Wait for the right setups and hit those singles, right? We don't need to hit home runs all the time if we want to make money, right? Some of the best traders are just hitting singles, just getting on base over and over, a few percentage over and over. And every once in a while, they'll get a big 10, 20, 30% gain, but don't aim for those all the time. It's advised to use this tool in conjunction with other analysis tools and methods to cross-reference information and perspectives. Don't rely on only one tool for analysis and predictions, as it can be inaccurate. We also want to consider trading volume, especially during periods where the price action may test a support or resistance level. If volume is high or higher than usual, there may be a greater chance of the price breaking through that level compared to periods of lower volume.